The first thing we need to do is determine the manufacturing cost per unit under variable costing. We would include direct materials, direct labor, and variable manufacturing overhead. So the manufacturing cost per unit is $15.75. The next thing, or part B, we need to go and calculate a variable costing income statement. A couple of things I want to point out before we go to the income statement. We sold 80,000 lures, but we produced 100,000. So again, we sold 80,000, and you're going to multiply that by the selling price of $28. Our variable cost is going to be the 80,000 times $15.75. We're also going to include our variable selling and administrative expenses of $4 times 80,000. Our total variable cost is $1,580,000. Our contribution margin is the difference between our sales and our variable cost, or $660,000. From there, we're going to incorporate our fixed manufacturing overhead as well as our selling and administrative expenses. Again, our net income under the variable costing method is $132,700. All right, now we need to determine our manufacturing cost per unit using absorption costing. Under this method, we would include direct materials, direct labor, manufacturing overhead, and we also would include our fixed manufacturing overhead. Again, our fixed manufacturing overhead is $290,000. We produced 100,000 lures, so we're going to include $2.90 for our fixed manufacturing overhead. If you add up those items, our product cost is $18.65. And again, similar to the variable costing, we sold 80,000 lures, so when it comes to our income statement, that's what we're going to use as the units that were sold. All right, so again, we sold 80,000 lures at $28. Our cost of goods sold, 80,000 times our product cost or our manufacturing cost of $18.65. Our gross profit is $748,000. If we subtract our variable selling expenses and our fixed selling expenses, you'll arrive at net income of $190,700.